Hello everyone, let's get started with Chapter 8. So what we're going to take a look at in this first module is how we account for property and equipment. Chapter 8 takes a look at 3 activities associated with accounting for property and equipment. We also call those fixed assets. Fixed assets are tangible in nature, which means we can touch them. Acquisition of fixed assets is one of the 3 activities we're going to look at. How to depreciate the items. Up to this point, you've just taken a debit to depreciation expense and a credit to accumulated depreciation. So by the end of this chapter, you'll figure out or will have learned how that number comes about. And what happens when we dispose of fixed assets if we have a gain or a loss. Next, we're going to take a look at recording fixed assets. So fixed assets is any tangible resource. Tangible means we can touch it. That is expected to be used in the normal course of operations for more than 1 year. So what that means is it's not intended for resale. If it was intended for resale, we would have put it into inventory. So it's going to be for our usage. It's going to slowly over time help us produce revenue. Examples include land, buildings, equipment, and furniture and fixtures. Recording of fixed assets, we have to take a look at the following items. Included in the cost of the fixed asset is the purchase price, taxes paid on the purchase, fees such as any closing costs paid to attorneys or commissions, any delivery costs, insurance costs that are during transit. These would not be the insurance costs that you would pay once you own the asset and you want to protect it from damage or from theft. And then any installation costs. So what you want to think about is, what do I need to get that equipment ready to be used? That's what would be included in the recording of your fixed assets. So look at an example here on the next page. We assume that Dozer Building Supply buys a delivery truck, and they pay the following amount. They pay $60,000 for the purchase price. Sales tax is $3,600. We have some county fees like DMV fees. We've put a GPS system in it so the truck would know where to go when we do deliveries. And then we have insurance. So what we have to determine is, of these costs, what would go into the debit to equipment. On the next page, there lists that they have decided to debit equipment for $65,000 and credit cash. So all of the costs, with the exception of insurance, is included in the debit to equipment. So that was the original purchase price of $60,000 plus the sales tax of $3,600 plus the $400 of county fees plus the GPS, because that's going to help us find your house, which totaled the $65,000. The only item that is not included is the $1,400 of insurance. So when we expense a fixed asset converts to an expense as it is used or consumed. We call that depreciation. It is the process of allocating the cost of a fixed asset over its useful life. Depreciation is recognized each period to apply the matching principle, and accumulate depreciation expense is called accumulated depreciation. If you remember correctly, we called that a contra asset. And we also have decided that depreciation does not happen for land. So remember, for accounting purposes, depreciation is a process of allocating an asset's cost, not a method of determining the asset's market value. It's just a method where we could expense it slowly over time. So what we're going to do next is we're going to take a look at page 207, exercise number 1, and we're going to go ahead and take a look at what we would book to the equipment account. So Orange and Blue Inc. incurred the following expenditures when purchasing land. So in this particular case, we're going to look, what are we going to debit land and what are we going to credit? So the land has $47,000 for the land. We also have $4,500 in taxes. So we have land, taxes. We also had $2,000 of sales commissions. So $2,000 of commission. And then it goes on to say we had $13,000 for clearing and grading, of which $8,000 was for removing the old building. So in our case, we're going to go ahead and add the full $13,000, which comes up to, let's go ahead and take a look at this. We have $47,000 plus $45,000 is $51,500 plus $15,000. So we get $66,500. So everything is included in this, and what you have to ask is the land in condition for its intended use without grading and removal of the building? The answer would be no, so therefore that's why we include it. So let's go on to depreciation.